Now, it's taken 4 years, but at last inflation has now reached the Bank of England's target for the first time since November 2009. It's running at 2%, lower than many predictions, which led the Chancellor of the Exchequer today to claim that his plan for the economy is working. Labour replied there was still a cost of living crisis, but if inflation stays low and the economy keeps growing, could people start to feel differently? Andrew Verity reports.
Cost of living crisis? What crisis? The scourge of inflation's been stamped out. So if it's only 2%, why don't we feel better? You know the answer. Wages are rising by less than half that.
For more than 30 years, the debate about inflation has been dominated by what the older generation think they remember about the 1970s. With prices rising by 10 or 20%, the cost of living became unaffordable and we all got worse off. Right? Wrong. Back in the 70s, prices may have risen, but what often gets forgotten is that wages were rising even faster. So take 1975, when prices rose by 25%. In that year, household disposable incomes still grew in real terms. In the middle of out-of-control inflation, we were still getting better off.
Stripping out inflation, in the 1970s we got better off on average by 1.2% a year. In the 1980s, incomes went up by 2.2%, in the 90s by 1.3%, and in the noughties by 1.3%. It's only since then that the average income started to fall in real terms, and it's fallen fastest, not in the recession, but the recovery. Why, if we're in recovery, aren't we claiming higher pay rises?
For the last 5 years, we've been through a really difficult economic situation, and a lot of people seem to have been prepared to accept lower pay to help secure their job. But if we look what's happening in the last year now, employment is growing, the economy is more obviously growing, so I think people will feel more secure in going forward and saying, I think we need a pay rise. Now what will be interesting is, as we get through 2014, as real wages start to rise again, but real wage growth remains historically very weak, does that change the debate?
Not all employers can say they can't afford bigger pay rises. In fact, companies have built up a pile of cash worth £671 billion. With prices rising faster than wages, they've been getting more money in from the goods they sell and paying out less to their staff. Why can't companies spend that giant cash pile on bigger pay rises?
But the cash belongs to shareholders and they expect it to be invested for a return, which means those workers need to be more productive, using more up-to-date technology, delivering new products and services in order to generate a bigger return for the business. Higher wages flow from productivity growth. But yes, after several pretty flat years in which living standards have declined, if we now have the prospect of keeping inflation at 2% and skill shortages and pressure in the labour market enables workers to earn more value by being more productive, then wages should modestly grow this year.
The other thing that gets forgotten about the big wage rises of the 1970s is that if you're in debt, they did you a big favour. Your wages would go up with inflation, but the amount you owed wouldn't. Inflation makes your debts shrink. Not that that's at all relevant these days.
The big fear of the 70s was a wage price spiral, when companies fund big pay rises by charging higher prices, and then workers demand even higher pay. But with pay claims as meek as they are today, there's little danger of that.